In this session, let's talk about the employee stock option, wherein we would basically understand what they are, and we'll talk about the contractual arrangements which they carry, and do these options really align the interest of the shareholders and the managers? Are there any possibilities of agency conflicts that can come up? Then we'll talk a little bit about the accounting related issues and how do we do the valuations of the employee stock option. Just getting introduced to the world of employee stock options, they are simple call options, right? They are simple call options that are given on a company's stock, call option on a stock given to the employees of the company. So these are not the ones that are traded on the market, traded on the exchanges, but these are the ones that are given by the company to its employees. So this is a mechanism where an employee is getting a stake. So where an employee is getting an opportunity to buy the shares of a company at a slightly lesser price. So if at all the employee wants, because it's an option, if at all the employee wants, he can exercise the option. And obviously, when will he do that? If the company does well, so there is a chance that the company's profits will go up, which will result in the stock price of the company going up. And that is where the employees will think of exercising that call option. So they'll get a positive payoff. Their payoff is positive there. And the moment they are buying that share at a strike price which is lesser than the spot price, that difference they are going to realize by selling the stock. They are immediately buying the stock and selling it. They are buying it at a strike price which is lesser than the market price and immediately selling off the stock at the market price itself. That is what is the way they can make a gain through this employee stock option. And even from the company's perspective, the motivation for them, especially for technology companies, this is the best way they have really felt to attract and retain the best employees. And this kind of a mechanism results in giving a very attractive pay packages in the form of the stock option. And what we see is some companies, they try to offer it only to their senior management, whereas some companies, they offer it at almost every layer in the organization. Generally, this model goes very well with the startup companies because they may not have the required resources to pay all their employees what they would really get in the market, right? If I am a very experienced person, probably if I join an established firm, if my salary is some X, the startup may not be in a position to pay me that X, match my salary which I get with the established firm. So the only way I get attracted to a startup is they load me with bunches of stock options. So if the company does well, the shares are then going into the IPO, then the options become more and more valuable. I should be able to sell the shares at by buying them at a much cheaper price, sell them at a much higher price. So this is the major background behind the issue of stock options to the employees by the company. But however, post the crisis and all, we see that nowadays they are not that heavily popular as they used to be a few in the previous decade. But still, this idea has not died off. Still, the companies are behind in terms of giving the options to their employees and still looking at this being one of the mechanisms to retain the best talent. And just getting into the modalities of this ESOP, there could be some kind of contracts which can last even for 10 to 15 years. So which means there is a possibility that I can make the employees stick to the organization for a longer period of time. And whenever it is issued, the strike price is set equal to the stock price on the grant date. So typically they are called at the money options because the stock price is the strike price. The strike price is the stock price on the day the options are issued. So generally, some of the important features which we see with every ESOP, there is a vesting period. Vesting period is like a lockout period. The option cannot be exercised. Let's say it's a 4-year vesting period. Means after you join, after you are granted the option, you have to wait at least for 4 years to start exercising your option. So there is a kind of a lockout period there. That's so some companies may set it as 1 year, some of them 2, 4, whatever it is. Now, when the employee is leaving their job, whether it is voluntary or a termination, during this vesting period, all their options are forfeited. They can't exercise any of their options. But after this vesting period, so if the employee has left in the 5th year, so all the options that are out of money, they have to forfeit. And the options that are in the money, they have to vest them immediately. Means they have to pay the strike price and exercise the option immediately. Not again at a later point. Now whether they want to sell off the share or retain the share, it's their problem. But at least the options which are in the money, they have to be exercised immediately. And if that option is out of money at that point, they get expired. So whatever the decision that happens at the time of leaving, whether they exercise it or expire it, that's over. It can't be that they can keep it after leaving or after quitting the company. And employees are not permitted to sell the options. The only thing they can do is exercise it, right? And probably either hold the share or sell the share. So whatever they do, they have to do with the share, not with the option. So this is one of the prime reasons we find that in case of employee stock options, the employees really try to exercise early itself. Whereas we talked about that a regular call option issued on the exchange, there is no motivation for exercising it early. Whereas when we are talking about ESOP, it is very much a benefit to exercise it early because I can't sell it at any point. So the only thing all I may have to do is buy the underlying share and either hold it or sell it. So when the employee is exercising at any point in time the options, the new shares are being issued by the company and those new shares are being sold to the holder of the option for the strike price, which in general is lesser than the spot price of that particular share in the market at that particular point in time. So this is where I have to talk about the early exercise decision. If at all I want a cash from the option, the only way is I have to exercise the option, buy the share and sell it. Because I can't sell the option to someone else. That's a kind of a restriction. Whereas if we are talking about the options that are listed on the exchange, I can very well take an offsetting position and I can very well virtually get rid of my option. The same thing does not hold true in case of ESOP. So the tendency, what we generally see in the market is the people try to exercise the options early than what we are seeing with respect to the exchange traded or traditional over the counter call option. So this is one major significant difference we see between the employee stock options and the traditional call options that are listed on the exchange or over the counter. But one thing is, if the employee is more desired of just maintaining a stake. Now it depends on the employee's objective. The objective is to make cash. The best thing is exercise the option, sell the underlying share. Whereas if the intention is to maintain a stake, then better keep the option. So in this case, at least I don't need to pay the strike price today. Even at a later point, I can very well pay it unless I leave the company. Even at a later point, I can pay the strike price. So I'm maintaining the strike price with me, which might fetch interest elsewhere. So I am delaying the process, and so the strike price of a very small amount may have to be paid at a much later point in time. So there is an insurance value that is getting created out of that option. So if my intention is to maintain a stake, put it almost towards the end. And one thing which we see is, depending on the kind of company, depending on the number of different types of employees within the company, we see that the early exercise behavior of the employees changes from company to company. Now, the major question that comes up is, whatever the options that are being issued, the stock options, do they align the interest of the shareholders and the managers? See, first thing we have to understand, from the investor's standpoint, if at all they need to have any kind of confidence in the capital markets, it is very much essential that the objectives of the interests of the shareholders and managers need to be well aligned. The investor is a shareholder in the company. Only when the interests of both the parties are well aligned, only when the shareholders, only when the managers are working in the best interest of the shareholders, only when the managers are taking their decisions which can help to boost the profitability and the returns to the shareholders, that is where the alignment is happening more and more proper. Because the major thing in any organization is, the managers should be motivated to take the decisions which are in the best interest of the shareholders. They should act as agents of the shareholders. Every task that is performed by the managers should really add value to the shareholders. And if at all their interests are not aligned, the company has to take an initiative in terms of aligning both their interests. Otherwise, there is a loss that the company is going to incur if their interests are not aligned, and that is what we have termed them as agency costs. Now look at, probably if these options are given to senior executives, right? Now the senior executives have a lot of momentum. Put pressure on the employees, make them slog, make them work for longer hours in a way that it adds to the profitability of the company, and in a way that it can boost up the share price, and in a way it can add up or provide additional compensation to the senior management. Especially in a startup firm, if there is a plan for the company to go for an IPO and the company is successful, probably the value of the option is going to be more and more heavier, which means it will really motivate the employees to do well so that everyone will get profits out of it. But if the company is not successful, probably the whole effort that has been put into it is going to be of a sheer waste. So that's where it has to be looked at. Now, if the company does badly, let's look at in terms of an established company, right? Let's look at an established company. Okay, if the company does good, because all the employees have worked well, company does good, so the profits of the company are up, the share prices are up. So because the share prices are up, even the options that are given to the employees, the option prices are also up. So the employees are going to exercise their options, and they are going to be more and more beneficial. Very much agree. But look at if the performance of the company is very bad. If it is bad, the profits are less, which means the losses are high. The profits are less could result in stock prices falling down. Stock prices falling down, the shareholders are at a loss. But what is happening to the employees who took the employee stock options? They will not exercise the option, they will expire it. Now, because of that, they are not losing anything. They are not gaining, but at the same time, there is no loss for them. So, there is a shield that is coming out for the employees, which will actually make them take more and more additional risk, which they would not do in an otherwise kind of a situation. So, this is where there is some criticism with respect to the employee stock options that are being granted. Should the employee stock options be given, or should there be something like a restricted stock unit? Means here there is no option. This gives the right for the employee, or it is like 1 unit of a share is given to the employee at a future date, right? Rather than an option to buy it, it is provided, it is given, one unit of a share is given to the employee at a future date. So it means even the losses are taken care of by the employee itself. So sometimes it says that restricted stock unit is much more aligning the interests of the shareholders and the managers compared to the issue of a stock option. So there is a tempting, especially from the employee's perspective, whatever they want to buy, whatever the shares they want to buy, they'll wait for the good news because they are insiders. So they will just try to make their purchase decision just before a good news, so that they are just after some kind of bonus issue has been made, so that they can immediately purchase the things at a much lesser price. But typically in a large number of cases, having an insider information and making a decision which reflects that insider information is treated as illegal. And to a large extent, the negative side of these options is every employee would focus more and more on short-term profits. I want big amount in the short term. So instead of looking at long-term sustainable kind of a growth, sustainable kind of profitability, the focus of almost every employee would be on the short-term profit, because these particular instruments form a very large composition of the compensation plan. So it always motivates the employees to run behind short-term profit rather than looking at a long-term stability. And many a times it so happens that the senior managers, they just start thinking, oh, what are the different ways in which I can get much more money? How can I make much more bigger? So it's only a thinking and worry about the compensation that comes every time, rather than thinking through how to improve the operations of the company. So the productivity levels can fall to a drastic extent. And whatever the inside knowledge the management manager is having, whatever the expertise, whatever the knowledge about the operations of the company which a manager is having, if he takes his decisions, if he makes his trading in such a way that it impacts the other shareholders, then probably it's going to be a much more at a disadvantage for them. So it is in this context, all the regulators, they put some kind of they put requirements that in case any executive is looking at buying or selling their own company's stock, they have to give enough notice to the market, at least a week's notice, so that the market will try to analyze that information and take the decision appropriately. Alright, now let's look at a few accounting issues associated with the employee stock option. Look at an employee stock option being granted to an employee by the company, and that grant is to buy the share of a company at a strike price at a future date. So basically, because it's a grant the company is giving to the employee, I can look at it as a cost to company and it's a benefit to the employee, just like any other form of compensation. But many a times the employees don't believe it as a benefit because it is not in the money. Many a times it's the at the money options that are being issued. So people start arguing because it's at the money, it's no cost to the company at all. So it's not a cost to the company, so it means it's not a benefit to the employee. Right? So but look at it the other way. The employee will get some benefit out of it in future. So if they are valuable to the employees, they should represent the cost to the company. Now, where is this cost coming from? This employee is having an option, right? The company has agreed that at least in some cases, at least if the stock is doing well, it can sell the shares to the employee at a much cheaper price, at the strike price, which is lesser than the market price at that particular point in time. So the company is really bearing that additional risk in terms of selling the shares to its employees at a price which is lesser than the market price. So that difference is what is the cost to the company. And expensing all that stock based compensation should happen at fair value in the income statement. And every time the option needs to be valued on the grant date, and it has to, whatever is that expense, whatever is its value, it has to be recorded as an expense in the income statement for that particular year. And every year the same process has to happen, right? The option valuation has to happen based on the number of years still left to the maturity. And if the in the next year the option is becoming more valuable, so the expense amount is increasing. If it is becoming less valuable, it is adding up. It is decreasing the expense, means it's increasing the income component on the income statement. So that is what is being mentioned as a part of the accounting issue for the option. Then let's look at a couple of valuation procedures associated with the option. There are different ways in which I can find out the value of the employee stock option. So one of them is a quick and dirty approach where I use the Black-Scholes-Merton formula. And what I do for that is I look at the expected life of the option. Expected life is average time for which the employees hold the option before it is exercised or expired. So some people leave the company, some people resign, some people are terminated. So looking at all these things, some people exercise it very early. So looking at all these things, I really want to find out what is the approximate time for which the employees hold the option. And generally we estimate that from the historical data. Right, depending on how many employees have exercised earlier, at what times they have exercised, we can do some kind of analytics on the historical data and we can very well retrieve that particular figure. So it reflects the vesting period, right? Probably the lockout period before which the option cannot be exercised, and leaving the company, what proportion of the employees typically are leaving. The tendency for the employee stock options to be exercised much earlier in comparison with the traditional call options that are listed on the exchange or over the counter. So all these things I take into consideration and finally compute what is the typical early exercise behavior of the employees, based on which I would compute the average time, which is what we are calling as the expected lifetime of the option. And from there I use the Black-Scholes-Merton model. Life of the option is set equal to T, and volatility is estimated from the several years of the historical data, based on which we are computing the income statement expense that comes out of this issuance of the option. Probably we'll take one numerical which can help us in understanding this entire flow quite comfortably. Let's look at this. A company grants 1 million options to its employees. Number of options granted. It is 1 million options that are granted to their employees on 1st November 2014. Though the date may not be of any significance, let me just make a note. The stock price on that date is 30. Stock price is 30. Strike price also is 30. Strike price for the option is 30. The option lasts for 10 years and vests after 3 years. So option period is 10 years, vesting period is 3 years. The company has issued similar at the money options for the last 10 years. The average time to exercise or expire is 4.5. So I have the historical data. Average time to exercise or expire is 4.5 years. Long-term volatility of the stock during the 5 years historical data is 25%. So the volatility, I can take it as 25%. Present value of the dividend during the next 5 years, present value of the dividend that are going to be declared in the next 5 years, we are calling it as 4. And the 4.5 year zero coupon risk-free interest rate is taken as 5%. Now from there I have to find the income statement expense. Now the same logic, I can use the Black-Scholes formula here as well. Right, now I'll take D1. D1 comes out as log S by X plus R plus sigma squared by 2 multiplied by T here. I'll take it as 4.5 years. R plus sigma squared by 2 into T divided by sigma into square root of T. Sigma into square root of T. So the T that is going is the average time to exercise this option. So D2 comes out as D1 minus sigma into square root of T. Sigma into square root of T comes out as D2. D1, D2. Now again I can find the area under the normal distribution curve, which is ND1. So I'll take norms dist with respect to the D1. And similarly I can do ND2, which actually goes with the same. Then I can find the price of the call option. Okay, here first of all I need to adjust the stock price because there is a present value of a dividend. So probably what I'll do is I'll adjust the stock price. So the current stock price minus the present value of the dividend. So this 26 is what I have to take wherever I am using the stock price. So these are my ND1, ND2's kind of stuff. So the C, which is the price of the call option, the modified stock price times ND1 minus the present value of the strike price, 30 by e to the power of RT. So 30 by e to the power of RT times ND2. So the price of the European call option here is 6.3. Right? One single European call option here is worth 6.3 and the company is granted this much, 1 million option. So the expense to the company is 6.3 times 1 million. So which is what is the expense, which is of 6.3 million. It would be showing as a part of the financial statements, as a part of the income statement associated with this particular option using the quick and dirty approach. Similarly, the company can look at using a binomial tree approach. The only thing is bring in some additional rules, especially while doing the rollback. Especially, okay, at every stage, is the option vested? What is the probability of the employee leaving the company? What is the probability that the employee is choosing to exercise the option? Build all those kind of probabilities and work backwards to arrive at the value. So you can use all the historical data, turnover rates, which talk about at each stage what is the probability that the employees will leave, or probably you can use the historical data to understand what is the probability of a premature exercise or forfeit because the employee has resigned, or in some cases what is the chance that the employee has exercised the option at different nodes of the tree. He is still with the company, but as we said, there is a tendency for the employee to exercise early and try to hold or sell the share in the market rather than he being in a position to sell the option itself. So what is the probability associated with that? And what we see is that particular probability will increase as the ratio of the stock price to strike price increases. Probability of exercising the option will increase as the ratio of the stock price to strike price is increasing, because the option is becoming more and more in the money. So the chances of exercising the option become more and more. So they want to exercise the option at the outset. So when we are seeing that the ratio of stock price to strike price is higher and the time to maturity of the option is going down, they don't mind exercising the option on a heavier basis. So the probabilities of the exercise will increase in that situation. So we can use the binomial tree which we have used with these kind of additional rules and additional formulas going into the calculation. But this is one more way we can do the valuation and find the expense. The third method which has been suggested by Hull and White is the exercise multiple approach. So it is making an assumption that the employee exercises any option the moment it is vested. The moment the vesting period is over, the employee is going to exercise the option, and the ratio of the stock price to strike price is above a certain level, and that level we are calling as the exercise multiple. So the moment we reach the vested date and the moment I see that the stock price to strike price multiple is above a certain level which is being decided, it is at that point the employee is going to exercise that option. So again, the valuation of the option can very well be done using a binomial tree or a trinomial tree kind of an approach. But again, the numbers associated with estimating that multiple, they have to be calculated from the historical data itself. But this is one more method which is slightly simpler compared to the earlier ones which we are talking of. Then in some cases, there could be a market-based approach where you could simply see what the market is willing to pay for it. Or there could be a dilution-based approach, because every time a new stock is issued, like through the stock options, every time we see a new number of shares are going created. Because of the creation of new shares, there is a possibility of dilution in the existing stakeholders. The value of the existing shareholders, the share price is going to be diluted because new shares are getting created. And new shares are being sold at a price which is below the market price. So all I want to see is when I make an announcement, and we have also talked about that it is not on the day the option is given, the share price is decreasing. On the day I am making an announcement of giving options to my employees, that is the day on which the whole stock price starts falling. So the moment an investor hears or the market hears about the stock option grant, it immediately reacts to it. Now this number, like the moment I make an announcement, I'll see by how much extent the stock price got diluted and by the market. This dilution, I'll work backwards to identify what should be the value of this stock option. I'm not using any other practices or procedures, no black shows, no binomial tree. I'm seeing what is the extent of dilution that is happening to the share the moment an announcement of a stock option is being made, and that assuming that that is the cost, I'm directly treating it backwards into the income statement as an expectation, as the expected costs of the exercising of those issuing of those options. So that's what is a very a brief understanding of the employee stock options, where we have spent some amount of time understanding what they are, what are there as a part of the contractual arrangements, do the stock options really align between the interests of the managers and the shareholders, some basic understanding of the accounting issues as well as the valuation methods for the employee stock option. All right.